When retiring, you have to understand that living in different places can have different effects on retirees. Whether it's the community, the tax laws, or just access to amenities, it's different everywhere. That said, everybody wants to retire and have as much as they can, so being able to retire someplace where you get all you need is good. What we can talk about with you is where you can save up on taxes and fees and still be able to financially take care of yourself. This is Intelligentsia, real-life advice for practical and financial goals. Today, we want to talk about state taxes, some considerations about them, and some differences between certain states. So let's get to it. The general idea with wanting to reduce our taxes doesn't need to specify what taxes we want to save up on, but rather the overall amount of taxes. When people talk about wanting to save up on taxes, some people just want to know what taxes they can save up on, but if they end up paying more for other forms of taxes, it wouldn't make a difference. But if you look at it as a whole, then perhaps that would be different. There are multiple reasons as to why you'd want to consider state taxes when it comes to retirement. The following are just some examples. Taxation of retirement income. There are states that tax retirement income such as social security benefits, your 401ks, and your pension. The main idea here is that you'd want to know how your state taxes you. There are some states that have a very high state income tax rate on wages, but no state income tax rate when it comes to retirement distributions or pension distributions. The differences between how your state taxes you can affect your budget as a whole, mainly because you could be saving up on tens of thousands of dollars if you decide to retire in a state that doesn't tax your retirement income. Some states like Illinois, Pennsylvania, Mississippi, and Iowa will tax your working income, but you won't have to worry about your retirement income as a result. One way or another, your state will have to figure out how to make money from taxes. Now, you can't escape taxes altogether, but you can choose to reduce it by choosing a state that doesn't tax a majority of where your income comes from. Regarding the states we've mentioned before, Illinois, Pennsylvania, Mississippi, and Iowa, it would be beneficial if you decided to stay in these states if majority of your money came from retirement income. This also helps you with tax efficiency. It's important to structure your retirement investments and income in a tax-efficient manner. If you know your state's tax laws, you can stay informed and make proper decisions on which accounts to draw from and when to minimize your tax burden. Certain states also provide tax incentives for retirees such as property tax exemptions or credits for senior citizens. Staying informed and being aware of these incentives can help you maximize your savings. Another thing to consider is the cost of living. When you think about it, when you get taxed more, the pricier the thing you're buying is. You also get taxed more the more you make. States differ in terms of the cost of living. Many high-tax states often have higher living expenses, while the lower tax states can provide a more affordable way of living. If you factor in state taxes, it could provide you a better idea on how your money is going to be spent. Is it going to be spent more on taxes or more expensive amenities? That said, when choosing what taxes to pay, it's not always important to pick and choose which taxes you'd like to pay and which ones you'd like to reduce. The general idea that you'd benefit from is having your overall taxes go down. Taxes, regardless of where they come from, function the same way. You can choose to move to a no-income tax state and save money on state income taxes, but if you have a larger property tax bill, you may actually end up paying more taxes. The thing you want to be doing here is that you want to save up on taxes and not pay more. One example of this is Hawaii. Hawaii is ranked as the lowest effective real estate tax rate, but the median home value is pretty expensive. Healthcare costs are another thing to consider when talking about cost of living. As healthcare is a major expense that can eat up most of your retirement income, understanding that some states have more affordable healthcare options or programs for retirees can help out a lot. These factors influence your retirement location and budget as a result. If we're only going to be talking about taxes, because you're paying more for something, you end up paying more in taxes as well. Another consideration to make is if your state taxes social security benefits. Adding on to your previous point on whether your state taxes your working income or your retirement income, you'll need to factor in whether or not your social security benefits get taxed. There are some states that are considered high tax states. Some examples are Minnesota and Florida. While both are known to be high tax states, they both have different tax situations. Think about it like this. Minnesota taxes your social security benefits while Florida doesn't. While they're both known as high tax states, the situation is different for different people. If you make majority of your retirement income from your social security benefits, then perhaps moving to a state that doesn't tax it is in your best interest. Because your social security benefits get taxed in Minnesota, you get taxed a lot for your retirement income as opposed to Florida where they don't. You may just owe them a bit of change in state and income tax. If you understand how your state taxes you can save up a lot of money in terms of taxes. If you know where majority of your money comes from, perhaps adjusting your retirement plans to accommodate your income situation can help you immensely. Another important consideration to take account into is estate taxes. When talking about estate taxes, understand that the main people that get taxed for this are your beneficiaries. If you'd like to be able to assist in a way that you can, considering where you live in retirement is key in helping them out. Different states have different estate laws, and as a result, you may be taxed more in certain states than others. The general rule for taxes is that they're based on the state that you live in or the state that you passed on. That said, inheritance is taxed based on where your beneficiaries live currently. If you plan on leaving a significant estate, understanding the impact of these taxes is crucial for estate planning. You also have to take into account residency changes here. If you're considering moving to a different state in retirement, there may be some tax implications that can prove to be significant. Some states have no income tax while others have high rates. Your choice of residence can impact your overall tax situation. Think of it like this: estate taxes are imposed on the transfer of assets from one generation to the next. Since you're already planning on passing on your wealth, you could make it a lot easier on your beneficiaries by considering where you'll retire. Proper estate planning can also help you transfer your assets in the most tax-efficient manner. Strategies like gifting, establishing trusts, or using exemptions and deductions to reduce the taxable value of your estate are all important means to do so. Plus, a non-financial benefit from all this is that you can clear up any potential disputes from family members when it comes to the distribution of assets. Estate planning allows you to plan how much you'd like your assets to be used after your passing. This includes leaving a legacy for charitable causes or just making sure that your loved ones are taken care of after you pass. If you haven't considered your estate tax situation, your heirs may be forced to sell assets just to cover your tax bills. There are important state-specific considerations that you have to make apart from federal taxes in terms of planning. But more often than not, while taxes are important to think of when talking about your estate, the main goal is how your assets are properly utilized afterwards. There are many other considerations that may be useful to you, but the ones that we've outlined can help out with your retirement considerations. If you've enjoyed this video and found this helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we're pumped to have you in our next video. Stay mentally healthy, and let's get financially fed together.